All right, folks, I am back today. We are up. Stocks are up 500 points today. That was the best day so far this year. If you go back, a couple of things here. If you go back last week, late last week, when the market was coming down, everybody was selling, everybody was panicking, I said that support would be coming in very soon, within the next day or two. That was Thursday or Friday. I was saying that. Now, because I follow the flows in these bank reserve balances, and I've been trying to explain this to you through a number of videos now, how these reserve flows into the banking system, out of the banking system, and the volatility that has caused, because we are in an unprecedented situation where really two things have been happening. Number one, the Treasury is up against a debt ceiling, so they cannot sell new bonds, and the Fed has been engineering a decline in reserve balances now going on for like 2 years, a year and a half. So the combination of those things created like a perfect storm. It created a squeeze in the Treasury market. But another phenomenon attached to that has been this very extreme volatility in the Treasury's account at the Federal Reserve. The account swells up with money, then they spend it back out, the account goes way back down again. So this causes this seesaw effect in these reserve balances. It's why the market's been kind of bopping around. Now, I've been able to time that perfectly. I mean, it's very easy, if you understand this, to know when reserves are going to peak and when they're going to hit a trough. And you could trade off of that. My subscribers have been doing that. So I said, even going back before last week, I mean, if you have been with me as a subscriber, you know that early in May I said stock market would peak out because we're going to start to build reserves back again. And I gave the date. I said right around end of May, early June, it'll start going back up again because reserve balances will be coming down. All right, it's totally predictable. We can see from last year's pattern of and you know what's expected to come in terms of tax receipts, what's expected to go out in terms of spending. So I had that window, and I also know the window when the next peak will come in the stock market, and that equates to the next trough in reserves. All right, and the one after that. Now, if Congress raises the debt ceiling, the volatility is taken off, is taken away. We go back to this kind of smooth reserve balance maintenance, reserve maintenance. Treasury will be able to sell bonds to drain down reserves to the level they want, okay? Everything gets back to normal. And then, because the fiscal support is so strong, you're basically going to have a straight up stock market. But these clowns have to raise the debt ceiling. This is just, you know, outrageous mismanagement of the government's finances. But, you know, the bunch of idiots, we all know this in Congress anyway. On another note, and by the way, it's just, if I could say this again, I mean, I've said it so many times, the zombies, how they do the same stupid thing every single time. This correction, everybody went crazy again. Oh, recession is coming. I saw headlines, this is going to be worse than the 2008 Lehman crash. And I was here every single day. I had a couple of people on here posting up comments saying, oh, Mike, you never make a video when the market goes down, only when it goes up. Not true. I made them all last week when it was going down, all last month. And I said you have to buy the dip. We're going to go to new highs. And now let me segue to something which I think is very important to mention. Somebody or some people at the Fed, I believe they're reading my report. I don't know how they got it, but what the statements coming out of the Fed now. Today you had Vice Chair Quarles. He's talking about the impact from the tariffs will be negligible. Who's been saying that? I've been saying it. The Fed has been saying that they're going to continue to look at economic developments. They look at the market a little bit, but that's one minor factor. in a recent statement or note that they put out. And this is very, very interesting because they spoke about the Treasury General Account. That's the Treasury's account at the Fed, and they specifically mentioned the volatility in that account. Now that's something I've been talking about now since the debt ceiling that was back in March. I've been pointing that out week after week after week in my report, how that volatility in the Treasury's account is translating into volatility in the markets. Up, down, up, down, up, down. Underlying, we have very bullish forces. Now, I just sent out a thing a couple of minutes ago to subscribers. Again, if you want to get any of this stuff, you got to go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader or Zombie Trading. I just sent out something very, very interesting related to tax revenues, tax deposits to the Treasury. Employment and withhold. Here's another thing, because everybody's screaming recession, everybody's screaming slowdown. Tax deposits are blowing through the roof. Employment and withholding tax deposits are blowing, they're surging. They're just like, if you saw what happened now. Back at the end of last year, end of December, into January and February, they were plunging. And I noted this. And everybody who was my subscriber understood this, because the government shutdown created real drag on the economy. That was real. We saw that in the numbers. But then I said everything is accelerating, and while people were still so negative, I said we're going to go to new all-time highs, and boom, we went to new all-time highs. And now when everybody is saying the recession, these metrics, tax deposits, fiscal flows, bank credit, they're all very, very strong. There is no indication in any of these things of a collapse in demand. And as a matter of fact, if you look at these employment and withholding taxes, they're telling you one big story, two big stories I should say. Number one, the labor market is very strong, but number two, probably more importantly, wages and earnings are rising very rapidly now. They are rising. So this whole bond market thing, which was created by a technicality, which I talked about, this whole reserve thing, the debt ceiling, the bringing down and reserve balances by the Fed, has nothing to do with a recession. This was basically a squeeze engineered by stupidity by Congress, and I would almost say stupidity by the Fed. I mean, Powell could have said when he has these, he's up to testify in these hearings, hey guys, raise the damn debt ceiling. We need it. But no, he doesn't say anything about this because he's clueless. Like I said in the last thing, he is the worst Fed chair since Paul Volcker. So these things are eminently tradable. We are trading it, but you got to come on board. All right, folks, looking good, as I said, had to buy that dip. And also, I think the cat's out of the bag now. Vice Chair Quarles said the tariffs, minor impact, if any, on the economy. Those are my words. I mean, I've been saying that. So somebody there is reading my stuff. Bye.